Welcome to The Explainer. Today, we're diving deep into Aon, a global powerhouse in professional services, and we're looking at it through the lens of an investor. We're going to figure out what makes this company tick, and more importantly, if it's earned a spot in a long-term portfolio. So, to really get Aon, we have to start with a fundamental question, one that every investor should ask. What gives a company a real, durable, almost fortress-like competitive advantage? What creates that wide economic moat? Well, a lot of people believe Aon has exactly that kind of moat. It's a business built on a super resilient model. It throws off a ton of cash, and it is absolutely laser-focused on creating value for its shareholders. So, let's break down that investment case. All right, here's our game plan. We'll hit the core thesis, check out the business model and the financials, see how they put their cash to work, and then, of course, we'll talk about the risks and the price tag. Let's get into it. Okay, first up, the business model itself. This is really the bedrock of the whole investment case, and it's built on two really simple but powerful pillars. What's so smart about this is the simplicity. Aon basically boils down its entire complex world into solving two massive client needs: managing risk capital and optimizing human capital. It's all part of what they call their Aon United strategy, and it's specifically designed to get clients using more of their services, making those relationships incredibly sticky. And check this out, it really shows their global footprint. Yeah, the US is their biggest market, but no single region totally dominates. Now, for an investor, that diversification is critical. It acts as a buffer if one part of the world hits an economic snag, which makes their revenue stream way more stable and predictable. Okay, but if there's one single number that just screams stability, it's this one: a client retention rate of over 95%. Think about that. It means their revenue is incredibly predictable, it's recurring, they're not hunting for new business every single year, they're building on this massive, solid foundation of clients who stick around. So you have this incredibly stable business model, but how does that actually translate into financial performance? Let's pop the hood and take a look at the engine room of the company. This table tells such a great story of consistency. You can see that steady mid-single-digit organic growth, which is great, but look closer at that adjusted operating margin. See how it just keeps ticking up year after year? That tells you they're not just getting bigger, they're getting more profitable as they grow. That is the sign of a truly scalable business. But this right here, this is where Aon really separates itself from the pack. Its return on equity is just exceptionally high. This is a measure of how good a company is at making money from its shareholders' capital, and at over 50%, Aon is just in a totally different league than its closest competitors. That is the hallmark of a really high-quality business. And all of that incredible profitability generates massive amounts of free cash flow. Honestly, for an investor, this might just be the most important metric of all. It's the actual, real cash left over that the company can use to reward people like you and me, the shareholders. It's the fuel for everything we're about to talk about. Okay, so the company is a cash machine. Now comes the really important part. What do they do with all that cash? Because smart capital allocation is what separates a good company from a truly great investment. The headline number here is just staggering: $25 billion. That's how much they've returned directly to shareholders in the last 10 years alone. And this isn't some future promise. It's a proven track record, and it's driven primarily by one key activity. So management has a very clear, very disciplined playbook. First, they reinvest whatever they need to for growth. You see that with the recent NFP acquisition. But after that, it's all about sending capital back to shareholders. The cornerstone is massive share buybacks with a nice, steadily growing dividend on top. And don't just brush past this. These buybacks are a ridiculously powerful engine for growth. By constantly shrinking the number of shares out there, they make sure that earnings per share, the EPS, grows even faster than their actual net income. This bit of financial leverage is a huge reason Aon has delivered an 11% compound annual growth rate in EPS since 2014. Okay, so it all sounds fantastic, right? But of course, no investment is risk-free, and a high-quality company like this, well, it often comes with a premium price tag. So let's do a little reality check. As an investor, you've got to keep 4 key risks on your radar here. First, execution risk. That massive NFP acquisition needs to be integrated smoothly. Second, you've got growing regulatory scrutiny. Third is just the classic macro risk of a global recession. And finally, there's a cyclical risk. If the insurance market goes soft for too long, that could put pressure on their revenues. And this brings us right to the price tag. As you can see, Aon trades at a pretty noticeable premium to its main rival Marsh & McLennan on key metrics like EV to sales. The market is clearly giving Aon credit for its superior profitability, but that premium also means that expectations are sky high. So here's the bottom line on valuation. The market absolutely sees Aon's quality, and it has priced it for perfection. That means any slip-ups, whether it's in execution or a simple slowdown in growth, could really challenge the current stock price. There's just not much margin for error. And all of this leaves us with the final pivotal question. You're clearly buying a best-in-class business that has a wide, durable economic moat. The question is all of that excellence already baked into its premium price? For any investor looking at Aon today, that is the billion-dollar question.